Are we about to witness a banking collapse like we haven't seen since the global financial crisis? And what does that mean for traders and investors out there like you and I? Hello, ladies and gentlemen, and welcome back. Today we discuss the Credit Suisse situation, and more importantly, we look at the data to do with yields. Over the last 48 hours, we've seen yields switch from being incredibly bullish and everybody thinking we're going to 6% in the US to suddenly now under 4. So what's going on and what does the data suggest happens next? We'll be taking a look at all of the hottest charts and of course stocks, commodities, and crypto markets. Well, welcome back everybody to the Daily Show where we talk about markets. If it's your first time here, consider subscribing and smashing that like button. We produce daily content covering all of these stories. So of course, this Credit Suisse situation matters to every investor in the world and trader. Why? Because it's a massive bank. And it shows us since the Silicon Valley Bank incident that this is toxic across the world and probably partially systemic. But the good news is, like every other problem, it's okay because the governments are there to save the day. We're getting some liquidity promises potentially coming out of the Swiss government, and I do expect them to at least temporarily plug the holes. Remember, the system is broken, and every single time the Federal Reserve raises rates the way they've done and central banks around the world, we always get a break of the system. The question really becomes, how bad is this and what do we don't know? Remember, it's what you don't know that's really scary. If you haven't already, come and follow us over on our social medias as well as FX Evolution on Twitter. And remember that we're posting a whole bunch of kind of like explanations about things. One of those has got to do with credit default swap spreads. While this story is now a little bit old, of course, we knew Credit Suisse had been having really big problems with this. We mentioned in the previous video we were going to do a special on it. It's since emerged that it's become a massive issue. And what this shows you is the risk involved, according to bankers pretty much, or loaners, when it comes to dealing with Credit Suisse. That's a huge discrepancy, and it's the biggest we've seen since the global financial crisis and the European crisis of 2011, 2012. So it really just shows you here how much risk the market already saw this. Sometimes it's the things in plain sight that become the most scary. So let's get into actually the data that I think is most important right now. And this has got to do with yield curve switches. Here we see the 10-year and the 3-year Treasury yield spreads, and we're taking a look at the 3-day net change. So what you can see here is that the long-dated yield is starting to get dumped off, and the short-dated yield is like, well, okay, we're also dumping off at a very, very fast rate as well. Effectively, when you get things like this, we can start to pull data of when this has happened in the past. And these are some of the points when we've seen huge differential switches like this. Notice the first week, 2 weeks, 1 month into some of the other periods. This is the S&P 500 after that's occurred. And we start getting kind of like a lot of shaky 55, 60% readings. Now, if you know anything about markets, you'll know that they're generally bullish. So when you start to get under 60% bullish readings, that can mean the bad things on the horizon. But if we actually look a little bit deeper into the stats, it also shows us some things to do with the institutions and, more importantly, the sectors that tend to do well. Now, I've been on the record for a long time telling everybody that I haven't been bullish on energy for quite some time. In fact, since June of last year, I really haven't liked oil, and I specifically haven't really liked the energy sector in general. This is because I believe we were getting closer to terminal rates and about to break something. And you can see here what's occurring. This generally is the beginning of the end for energy stocks, and energy starts to kind of like weaken over time. Why? Because we're having to cut rates. Energy is very, very linked to interest rates and the way that they work. If we have a look here, other assets that tend to move during these periods of time, you can see that when we see the 10-year to the 3-year Treasury spread increase by over 30 basis points over 3 days, other readings have shown incredibly negative results towards, and importantly, the 10-year and also the US dollar. So the US dollar goes to be basically 50 or even bearish in general. We tend to see gold actually perform a little bit better over this period, which we've talked about many times. And more importantly, we tend to see the US 10-year continue to weaken. Guess what that could be good for, guys? Everybody out there knows it's pretty much treasuries, and treasuries are the big benefit of a weakening economy, because suddenly one of the two instances when treasuries are half useful becomes a thing. When everybody hates them at the end of a cycle, and when everybody needs them at the beginning of economic weakness. This is also going to have a huge impact on earnings moving forward as well, as we know. So what a difference a week can make. Silicon Valley Bank, Credit Suisse, every other one of these horrible banks and horrible institutions coming out with issues. And then all of a sudden, we see going from basically an 86% chance of a 50 basis point hike to now no hikes, please. We don't expect you to do anything. Imagine if the central banks, such as the Fed next week, come out, or in the subsequent weeks come out and say, oh, we're going to raise it 25 basis points. The market is going to crack it. And really, most of the data coming out, remember they said they were going to be looking at 2 to 3 key points. Only one of them has come in okay, which is the retail sales and the PPI. The other things, such as the CPI, came in, I think, sticky and hot. And of course, the jobs numbers came in hot as well. So you've got 2 hot, 1 medium, lukewarm. Does that mean that the Fed has to take the hard stance? Well, now we will move to the central banks to see whether they're committed to supporting the economy and creating a new sugar rush, or whether they're going to take the hard line and say, we'll do whatever it takes. Supposedly, that's what Jerome has been claiming. We'll find out what his medal is next week. What do you think in the comments down below? Let me know today. I'm very interested to see what your comments are. So Fed tightening cycles, they always break something. This is most likely the breaking of the financial institutions. But remember, the central banks in particular are there to provide, they were created to provide liquidity for these banks. They are unlikely to not have knee-jerk, quick reactions to trying to bail out everything and as possible. Their key here is probably to bail depositors, to bail the money in the banks, and maybe not bail the institutions themselves. We'll find out their solutions, though, over the next coming weeks, because it's a very, very tricky situation. So the market's been following for a long time now the no recession path. I've brought this chart up heaps of times, but if you're new here, I just wanted to point out that in general, if we follow the recession path, remember this is what's happened so far, and we're here right now, we've usually seen new lows being formed after we get the recession call. And usually when we get a recession call, only a few months after that, on average about 5 to 6 months after that, we actually bottom off and we start going up. Now, why could we continue to see markets going down? Well, they often say that when bad news is good and good news is bad, that's not really a healthy environment. But when bad news becomes bad and good news becomes good, so they usually say that's a sign of the market bottoming off. And at least from a technical perspective, that's a healthy sign. So we know that forward EPS growth turned negative the other day. This is about a month ago, around that time when we were getting pretty bearish on the markets in February. So since that point, what's happened? Well, the markets have come down. But we do know that we could go into a kangaroo-style market such as 2015-16, or it could be more of a sustained kind of rally sell-off similar to the times of the tech bust, which is also a mid-cycle slowdown that occurred over there. So yeah, which one? We don't know yet, but I would be certainly thinking that earnings season is going to become the most important seasons moving forward through the next 2 quarters. Also, equity risk premium, this is not being taken into consideration. I still think that when a recession does arrive, which the bonds market believes is still going to happen, unlikely we get soft landing, at least according to them. Depends a lot on what the Federal Reserve's prepared to do, though. If they take the Volcker moment and say, you know what, we'll hold rates high, we'll provide liquidity, and we're going to scare people a little bit, well, then we have to expect this to occur. Now, when that happens, it could be a great buying opportunity. And obviously, if we look at it, it's going to be one of those points where the VIX is probably spiking up high. And we want to talk about the VIX a little bit as today's video. So when the Fed actually does pivot, which we don't know yet, but of course the market expects it, stocks tend to actually fall more. We know this because usually the system's broken and something becomes systemic. The difference this time has to be that central bankers are so fast to react to plug the holes that we don't know how far the market's even allowed to go down. I'm actually still relatively optimistic on markets, even though I know you might think, oh, this is all terrible and everything's bad. Yeah, I agree, it is bad, and there could be still new lows in the market, but I doubt this is the full economic collapse of the system. And the reason is because they're so fast to plug the holes. Remember the Euro crisis of 2022. What happened? Well, we saw a massive bailout from the UK government or the UK central bank. Then we had the FTX scandal. Now we've got Silicon Valley Bank and Credit Suisse. And each time they come to their safety. If you haven't already, come and check us out on some of our other socials. Follow our Twitter, TikTok, or of course go into our Discord or website if you're interested in some of the courses we offer. But let's get into the charts and check out the VIX to start off with. 30 VIX. So 30 VIX is the resistance. It's clear that this level is hard for it to break. And even during the Credit Suisse disaster of the last 24 hours, it wasn't able to make a new high. Now with the VIX, usually, or traditionally anyway, when we're putting in lows, we tend to see a 40 plus VIX. So we still haven't seen that since 2022's crashing in the markets, whether it's been the Russia-Ukraine kind of war, whether it's been anything going on with the central banks or any other kind of instability in the world, we still haven't seen a truly fearful market. This just shows you how the market is. I'm telling you, if we were in other times where you didn't have central banks making knee-jerk reactions, we'd already be in some of these areas in terms of what's going on. But this was a paradigm shift. In 2020, when central bankers did what they did, they basically said we should never crash again unless we can't hold it. And that means that usually you're seeing rallies off a lot of lows. Once you get down to something like a 3,200 or a 3,000 S&P 500, again, you have to expect the central banks to constantly come back in and try to plug the holes. So you really need super toxicity to actually get the system to crack. And that usually means a not only recession, but my belief would be a great recession at that point, effectively a depression. I don't think most of you want that out there. Maybe someone in the chat does. I don't. I think it would suck. So let's move over. We need a VIX plus 40. We're looking for that. That often signals that these potential sell-offs are close to their bottom lows. So make sure you have an alert for a VIX plus 40 in the future. It could happen only over the next couple of weeks, depending on what the Federal Reserve does, and more importantly, how systemic this particular chart becomes. So you'll see here 216, and that closed down 14%, but that really doesn't show you the whole story. I know it says 178, but in pre-market, this Credit Suisse bank was as bad as like the $60s. It was sold off so heavily throughout the session. As we saw, of course, the major stockholders being, I think it was the Saudis, they said, we're not going to support it anymore. They obviously know that what's going to happen at this point is most likely central bankers will step in to provide liquidity. So probably a smart decision on their side and well played. Now, do I worry about Credit Suisse? Well, I can't really. I have to believe that the bankers of the world continue to move in on these things and plug the holes. So for now, you've got to think about every knee-jerk reaction is plug, plug, plug. I know it's frustrating, especially if you're looking at it, but you've got to be a realist out there. The only time they won't be able to plug is if it's toxic, like the global financial crisis, and usually it has to be in the biggest debt in the world, being in property. So if it's not there, I'm here to tell you I don't think it's actually epically bad. And I know that's weird, but it's the reality. Let's look at the yields now. US 2-year has made some recoveries, but the Credit Suisse situation pushed it even lower. So we're seeing a big divergence now between the current rate. So if you look at something like a US 3-month, so if we type in the US 03 MY, which you can then put on your charts if you're interested. You can see here 4.72. It's now basically priced in no rate hikes. That's the way it's looking at, or maybe 25 basis points. So maybe we go 25 basis points and then down. So this is now becoming the argument. Are we even going to go any higher? And yeah, this is going to be the one to watch over the next few months. Remember, the US 10-year over here is sitting at 3.57. Key level right there, sitting right underneath 3.32. If that closes below, then generally speaking, when the US 10-year goes on big epic runs, it tends to go on epic runs and then fall off epically. So you can see here, nice rally up, the end, slow, a gradual decline. Then we go into a new trend, big new trend, big new trend, big new trend. So if we do start to move below this level, we could be starting what we would call a new trend down, which means the economy is broken and most likely there's a sickness, and the central bankers of the world will come out with their little stimulus and provide liquidity to the banks while trying to combat inflation at the same time. Very tough situation. So is TLT benefiting from this? Yes. We saw the stats before. The US 10-year is expected to continue to drop based on those 3-year, 10-year spreads. And if that happens, then of course Treasury should theoretically do well. It could be a time when people feel like they need them. Now, there's a bit of articles coming out that say that treasuries are toxic. Look, I don't believe that in the US, but you never know. I mean, it's always possible. I think that's a bit of scaremongering, though, on the treasuries. If they're toxic, watch out. Get underneath the desk, put on a helmet, and then don't look out for at least 18 months because things will be really, really, really bad around the world. What about high yield junk debt? Well, we saw junk debt come out really bad. It was almost selling off to new lows and then failed to do it. The market since and subsequently rallied, and we've got the technical analysis to come with that very, very soon. Remember to watch junk debt. Dollar index filled the gap beautifully. This was the gap left open from Monday, and it came up to actually one of our critical levels we've been discussing for a while. So when it made the lower low over here and it broke through this, I said this in the private community, I was pretty bullish on the dollar at that point. And of course, I'm bullish on it into here. What would I like to see over the next 24 hours? I'd actually like to see this. Comes up, retests, it does that. Once it breaches underneath these lows, if this was to occur, I think the dollar will actually continue to weaken for a little bit. Now, why could that be? Well, of course, yields have copped a hammering and they'll have to come back into line to do with what the Fed's actually going to do. Now, I doubt the Fed is going to move as much as the market wants them to. So I think the market will get annoyed. I think it'll chuck a hissy fit. And I'm interested again in your comments down below, but I feel like the market's going to chuck a hissy fit at the Fed if the Fed stick to the mantra, which they've said they're going to. We will do whatever it takes to stop the inflation, and we're prepared to have a little bit of economic pain for that. Of course, they have to provide liquidity to the banks, but that is different to actually providing companies with bailouts. Let's find out which one happens, okay? Because we'll have to see here. Gold did well as yields dropped. That's to be expected. It's since come back into this zone. Nice rally there. Anyone that played the yield story, if you know how gold moves, of course, at the moment, if yields are getting thrashed down, gold loves it, and it's been moving up through that. Do I like gold at the moment? Not really. I think it's at a stabilization point, but I have been on, talking about how I think gold's going to $3,000 an ounce. And I think that happens over the next 5 years. Yeah, it's a big, long call, but I just need to see really more economic weakness. The more yields go down, the more gold, I believe, will go up. And that's the way, at least I see it. Now, here's the story, I think, of the 24 hours. Copper actually broke underneath and closed underneath 393. Now, we were looking for this for some time. I've been hating on copper for a while. This is bad for the Australian market, for the Australian viewers out there. Obviously, if copper is weakening, it's showing economic weakness here. So we're expecting copper now to move its way down to 370. As it moves down to 370, that should theoretically weaken off a lot of materials and energy sectors. And it just shows you that the market's starting now to say, well, maybe the Fed will hold a little bit higher. And maybe there's a little bit of pain to come. So remember, Dr. Copper is often the first to give you a warning sign of bad things on the horizon in terms of earnings and those types of things. Here we have US oil. It got thrashed. Previous day of close was below that purple line over here. Little bit over this zone, broke under, bang, straight down to 66, which is that last low over here. We finally did it. I've got to say I didn't hold the medal there. I obviously, around 75, ended up bailing on my shorts, but yeah, look, it did it. To the red box we go. I've hated on oil now for over 6 months, and it just shows you that when you have some form of edge, you are a pig effectively. That means that you are thinking something others haven't been thinking. You can really see the power of such a move if you understand the dynamics of the market. So congratulations to anybody that got this thing down to the 65s. You've done incredibly well. And now I expect oil to probably fall a little bit further and then hover around in here for a little bit. We'll find out whether yields switch. But yeah, right into that zone. Very interesting level here. And anyone that took underneath that 66 as a buy, certainly as a scalp, I can see why you do that. But I expect it now to start hovering in this area, possibly come down as low as 62 a barrel and move around in there. So it's actually interesting to look at oil again. Natural gas, not so interesting, coming back down to our level, and it hit our zone again, found a little bounce. I think this shows that there's a little bit of weakness here though. So like we've been saying, it's hard to stop the freight train. This is what we believe is the beginning of a base story, but now I think it might turn into a Wyckoff accumulation. Watch the zone. We'll be following it as much as we can. Let's move over to Tesla. Tesla bounced off this 165 low And it held pretty well through the day. Actually, it came out with two nice little buying kind of candle 2 hours here. So, I mean, maybe the NASDAQ continues to run up. It's celebrating the yield curves coming down. So it's celebrating something the Fed hasn't done. The question is now, will the Fed actually do it? Because the celebration could end there, yeah? I'm looking towards Tesla potentially doing something like this. So at this stage, we know that we have supports. They could become resistances. We have a gap fill sitting at just about 188. And I'm still thinking 150 gap fill is possible and probably probable for Tesla. But again, we have to play the game. What about the options for this week ahead? Well, take a look at this one. We'll just refresh this. So the options are switching all the time. People are closing the options. Still a lot of calls, 180, 190, 200 calls. We're currently sitting at 180. As long as the market basically closes underneath 180, they'd be pretty happy with themselves. Remember, it's Thursday coming up. This is the day that tends to be more volatile than the Friday itself. 2.4 million options expiring on Friday. It's the third week OPEX. Theoretically, the markets might want to hold on the Friday underneath 180 at this stage. We'll find out if they do. Apple couldn't be more boring. I know it's going up, but it's stuck in a range. You can see the expected weekly options high. I'm interested in the zone up here in this red box. So unless it hits that, I'm not really caring too much. And yeah, we'll continue to follow it, but there's not much going on. Nvidia is kind of the same. It's still in a bull trend. Bears, you don't have to be concerned yet. I haven't seen any signs that this thing wants to die yet. We still know that we have a gap up. We still know that we have creation. And look, we've also got here now a potential beginning of a bit of a wyckoff, okay? So we've got here kind of like a buyer's climax that could be coming in here, maybe a UT. Could we see a UTAD? And if we do, look at this, a gap up here. What if we like this, then gap down? Then we'll have an island reversal, which is one of my favorites. And if we report on this, I'll be very interested, okay? But at this point, nothing to be concerned about. You don't know it's going down yet. It isn't at this stage anyway. XJO, this is the Australian market. Well, it hates copper going down. So, of course, it's down again today. We're still sitting on one of my major supports. And I do think this is a critical level for the ASX 200 here. And this is the Australian market, by the way. It's basically banks, materials, and energy. So if you think about it that way, you can see why it's taking more of a bath than the other markets around the world. Definitely a struggle area for it. It needs to bounce here. I'm looking now to see whether we can get above that previous high of 7,080. If we do, then we might actually be seeing the low for the XJO for now. But at this stage, critical level, I could see buying. If it keeps coming down, probably draw something like a fib and look for the 61.8. So we'll probably update that should we breach through this zone. Watch this space. Let's look at the DAX for the European audience out there. DAX definitely weakened, made a new low. The most trade, or one of the most traded zones, actually sits around 14,000. I think this market looks weak. It does. It looks weak. We're seeing tech rallying, but still banks kind of folding a little bit here. Energy doing poorly. There's a lot of old economy stocks and things like the DAX. So this low here is very interesting. I know we reclaimed back above, but we closed below. I feel like rallies get faded on the DAX. We'll continue to follow it. Key level for the buyers is going to be getting past that 15,212 with daily close. We'll keep watching DAX. Let's move over to the American consumer. Is it sick? Well, according to this, it's getting sicker. Consumer discretionary versus staples, you can see here, continues to move down. And that's a fairly decent story here going on in the markets, and certainly something that you want to be watching. And I think this is probably one of those important ones to check out on the markets. By the way, if we're talking about like rotation, and we always are, you might notice that utilities was the best performing sector of the last 24 hours. Who would have ever guessed it? Yeah. Guess what was second? XLC Communications, staples, and then, of course, technology. So, yep, utilities got its breakout. Look at that. Beautiful. Nice breakout of the trend line. I've been calling this one for quite a few days now. And the reason why is because during periods of instability and also cutting of rates, why wouldn't you want to go and own some utilities theoretically? It's also a sector no one talked about, which I always do love. So here's the chart that everybody probably is interested in because they want cheaper prices. I know you all out there, you all like tech. So someone said I had cognitive bias because I said that the US 100 is bullish, yet the S&P 500 is not showing that sign at that point. And they said, oh, well, you've got to make sure that you follow the charts. Look, I totally agree with you. But remember, I use the S&P 500 as the true read of a market switch. The NASDAQ can give you a lot of false reads. So the breakout here was no doubt very bullish. It came back in the last 24 hours and found buyers and then rallied through. But you actually could have picked this up using the S&P, which we'll look at very, very soon. So here's the cues. Okay, stuck in the range, not much going on in terms of overall breakouts on the higher timeframes. Do remember the monthly as well. So we have to go back over to the monthly. You can see here the rejection wick coming through. US 2000 holding the demand zone. Beautiful level for it to hold. If it busts this, oh, watch out. Set alerts under here, guys. 1697. If that level gets closed below, I think there's a sickness, a bad sickness. Okay, so just watch that. 1697. We do not want that level taken unless you're a nasty bear out there and you want these markets to get crunched. If you do, you want that level to be taken. We know the S&P 500 still sits below its daily 200. We know it also sits below one of my most important zones, which is 3970 to 3980. I want to see that closed above to really show us we're in a new demand trend. At this stage, we're still in a downtrend on the higher timeframes, but something did switch in the last 24 hours, and that is that the markets actually came, there's expected weekly options highs and lows. The markets actually switched the trend and they went bullish, and we just hit targets on a lot of the short-term timeframe stuff. If you're interested in finding out how you'd manage to actually get into this trade, it was a classic case of our advanced scalping masterclass. Links in the description down below. I'll check out a bit of a discount on it if you're interested, because this was an absolute animal trade, and certainly they're very, very easy to get if you're watching the session. Now, is it counter to a 2-hour, 4-hour downward trend? Yes. But I thought I'd put the 15-minute on just to show you guys what happened here. So we saw the market come in incredibly negative. It hit into a zone, which I'm telling you is major confluence. I left it there for weeks. You want to go back and watch the videos. I've literally sat it there and said it's very, very big key level. Now, it hit this zone, and then we saw a switch of trend, which put in a higher high early in the market session. Once we then pulled back, we pushed to the very lows, obviously scaring the crap out of a lot of people. And in here was an incredibly good buy. And since then, it's rallied up. Now, do I think that means it continues on? Well, here's the problem. It doesn't necessarily, because on the higher timeframes, what do we need to break through? 39.40. And I believe that if we do that, we probably then kick up to around 39.60 to 39.80, which is, of course, that key zone I'm talking about. Then we come down, and then you might want to look at potentially rally style situations. This is going to be the critical point. At the moment, we're coming back up into this supply. I don't know if I'd want to try to short the supply again. It's so obvious now. We've seen it many, many times. Previous video, we talked about this level being the short. It came down, hit the daily 200 the first time. If the market does go, let's say, bearish, daily 200 is going to be key. So let's say we go up here, 39.68, instantly reject back. That's going to be a big deal, closing underneath the daily 200. I still think buyers, though, will then recommence around in these zones down here that have been left. So be very cautious if you're a bear at 39.40. I would be looking at highs getting taken here minutely through the session, then instantly rejected. If that happens, could be a very nice stop loss hunt style situation. High risk, high reward, that type of thing. So yeah, I'm very, very skeptical around 39.30 to 39.40. Watch it, leave it on your charts. Remember, check your daily highs as well, because this is going to be a super critical zone. The way it interacts with these wicks here is going to tell us a lot about the next market move. At the moment, 2-hour, 4-hour trend is still down, but 15-minute and underneath, and maybe even 1 hour and underneath, are now currently bullish. Let's move over to the S&P. S&P options are pretty wild. So if we look through here, we've got a lot of options expiration. It's 5 million units. We know the market wanted to push the narrative of 400 being the maximum pain. We're sitting at 388. It certainly would make sense to chuck another rally through, then dump it a bit and get the most amount of money out of the OPEX, out of the third week options expiration. They are sneaky, 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 but 39.30, 39.40 will be the first test should we come up to that in the next 24 hours, which I suspect will probably put pressure on it. Look at Bitcoin. It got through our watch reaction level, then instantly rejected it, and when touched again, then instantly rejected it. I hope by now this shows you why these levels are so important to look at. And you can see here that Bitcoin is really still, yes, it's bullish on short-term timeframes and long, but overall, this is still where the bulls and the bears are fighting it out, an absolute critical zone. Closure above here, I believe, exposes 30K. And at the moment, I'm very interested to see how it interacts with this zone. So if we go down to a 15-minute chart, if you have a look here, we actually made a new low, but didn't quite get underneath this little level. So I'd like to see that taken. And when that gets taken to the low, then we could be looking at a temporary switch of trend towards the downside, which has all happened, which has probably sucked in a lot of volume you can see here. And this is only one exchange, but you can see that volume coming through. So I do think that there could be a trap being set here on crypto. It's being considered as a safe haven. I'm not so sure about that. We'll find out whether it's a safe haven if things go bad, but certainly one to be watching. Let's move forward now to the news, and we'll scroll through. And of course, we've got prelim UOM consumer sentiment coming out on Friday. The Thursday story is going to be all about Europe, though. We've got monetary policies, ECB press conference. I think it's a pretty big deal, and it's going to move currencies and probably stocks as well, especially through Europe. If you haven't already, come and follow us on, of course, YouTube. Click the subscribe button, smash that like button if you enjoyed the video, and then, of course, follow us on the other socials. Also, we're doing a free March giveaway for some of our courses. So if you're interested in possibly winning group mentoring with me, or, of course, the Advanced Scalping Masterclass, which had a banger trade in the last 24 hours, then you can check that out. Otherwise, have a great day. Good luck out there. Remember, practice risk management whenever possible in a market such as this. It could get very wild, and even watershed moments are possible. Bye for now.